So there's three really critical, we'll call them super important factors. It's the differences between renting a home or an apartment or buying and owning your own home. Now, there's a lot of differences and lots of different things to consider. But when you really get down to it, there's really three key things that I think it's important for you to know. Now, I'm taking a topic that I could spend an hour on, and I'm going to condense it down into 7 or 8 minutes. So this is not scripted. This is just me talking to you as a friend who's helped more than 1,000 people buy their first home, and a lot of them buy their first home and then later come back to me and upgrade, say, hey, Sam, I want to sell the house and upgrade into another home. Now, it's important for me to share this with you that I would say 98, maybe 99% of all the first-time buyers that ever bought a home from us never said, oh, Sam, I wish I would have never bought a home. I wish I would have stayed a renter for life. And I know that sounds self-serving because I'm a real estate agent. Just understand, you watching this video, there's a good chance you're not from my area. I mean, this video goes all across the country. So I get no benefit from telling you this information other than to know I'm sharing my experience with you, and hopefully it benefits you in some way. Now, if you're from Knox County, locally, or Central Ohio, yeah, I may have an opportunity to work with you in the future, and we would love that. So here's something to think about. If you're currently paying rent right now, I want you to think about when you sign the lease on your rental, your lease had a specified amount of money that you agreed to pay for probably the next 12 months. So I'm just going to throw out a number and say you're renting a house and it's $1,200 a month. Whatever you're paying, I want you to use that number in your head. Now, for 12 months, you're going to pay $1,200 or whatever it is. But at the end of the year, when the lease expires, they're going to raise the rent. Your rent is not going to be $1,200 a month. There's a very high probability they're going to raise it, and it's going to be $1,350 or $1,400 or whatever it's going to be. Now, you may say that sounds too high, but based on how much housing values have increased, the real estate taxes and homeowners insurance have gone up. So the landlord has got higher expenses. So he's going to pass that cost on to you through the increase in rent. Now, if you're paying $1,200 a month rent today and you're a lifelong renter for the rest of your life, it doesn't take long for you to get your calculator out and go, well, if the rent goes up $1,200 a year, just get your calculator out, take $1,200 and times it by 1.1. That'll be a 10% increase, and that's going to show you what your rent is next year. And whatever that number is, then you take that number and times it by 1.1 again, and you're going to see your rent is going to eventually go from $1,200 to $2,000 and above. Now, if you think I'm crazy, do this. Ask your grandparents, ask your parents, say, hey, Pop, what did you pay for rent before I was ever born? What did you pay? How much was rent back then? And then he'll give you that number. And I can tell you, when I got into the real estate business in 1986 in our area, the rents were very affordable. They were in the $375 to $400 a month. For the same property today, they're probably $1,200 to $1,500. Now, if you ask your dad, and you'll hear stories when you get to your grandpa, I can remember my dad telling me that he rented a house back in the late 60s, early 70s, and it was $75 and $80 a month to rent a house. Well, those days are gone. You can't rent a garage or a storage unit for $70 or $80 a month. And that is the point I want to make. And this is important. If you're paying $1,200 a month today, it's not $1,200 forever. But if you take out a fixed rate loan when you buy a home, your payment on your home, your principal and interest with the bank, if it's 30 years at, let's just say 6%, that payment's not changing. That payment will stay the same 10 years from now, while the renter who was paying $1,200 a month is now paying $2,000 or more. You're still paying $1,200 a month on that principal and interest payment. It's locked in for the life. It's the best deal you can get to shield yourself against housing inflation. Now, granted, you do have property taxes on your home, and they will go up over time. Homeowners insurance, of course, as the cost of materials and labor to fix homes for insurance purposes go up, your insurance rate's gonna go up. But don't panic about those two things. You're paying it regardless. You're paying it as a renter in your monthly payment, and your landlord's footing the bill, but it's part of your rent, or you're paying it in housing. So I wouldn't worry about that so much. So the benefit of owning is you're shielding yourself against really high rents. But at the same time you're doing that, I want you to think about this. When you're renting, at the end of, let's say, 10 years, you've got a desk drawer full of rent receipts and you got to use the house, you had the benefit of living there. And it's really only a partial benefit because you can't really modify the house or make it the way you want in most cases. So you've got the use of the house, but that's it. You have no tax deduction, no forced savings, where when you own the home, your loan balance that started here, you're paying it down. So you're gaining value or equity in the home. And at the same time, if you look at, I'm just using a number, a $200,000 house 10 years ago is now more than a $300,000 house today, just through the appreciation and the shift in inflation. So it's a forced savings account. And if you have children and you're thinking, hey, how am I going to put little Johnny through college? If you don't have a college plan, you've got the equity in your home that you can use. And I get a lot of people that come to me who bought their first homes, and they buy their first home and they start out modest because they're just starting out. It's better to own in most cases than rent. So they'll buy that modest home, and in 5 or 10 years when they outgrow it or their needs change, they'll call me and say, hey, sell that house for us. We want to buy a bigger house. We need now 3-bedroom, 2-bath, or a house with a big basement and another family room, or whatever it is. And they have the ability to springboard themselves out of their modest home into a nicer, better home, which suits them better. And they don't have to worry about the down payment or where the money's going to come from. The money's going to come from the sale of their current home. It enables them to buy the next house and move up. When you're renting, you don't have that forced savings. You don't have that benefit. If anything, the cost for you to live keeps going up, and it's eroding the difference of what monies you earn. Your cost of housing, you have a bigger percentage all of a sudden is starting to go out towards your housing costs. Whereas you own a house, as you get pay increases, you're benefiting, you're able to park cash because your mortgage payment over that 30 years or 15 years, your principal and interest is staying the same. So your cost to live is actually going down based on the percentage with your increased income. So a lot of people don't think about that, but that's a big one. I mean, a really big one. And something that I think is super interesting, the Federal Reserve did a study, and this was a couple years ago, and they said that the average net wealth of a renter was under $7,000, and the average net wealth of a property owner across the country was more than $250,000. Now, this is averaging everybody. So it's factoring in the first-time buyer that bought a home 2 years ago, and it's factoring in our parents that maybe have owned a home for 20 years or 30 years. But the point I'm making is there's a big difference between having $7,000 in wealth or $250,000 in wealth because they owned a home. And part of that gets down to that forced savings account. Every month that you're making your monthly payment towards that house, what's happening is your loan balance is going down, and in most years, your value of your home is actually going up. There's certainly cases, and you can look back over like 2008 to 2010, where real estate values took a dip. And as long as you didn't sell your house during that time, it didn't affect you, because as long as you still owned it, it doesn't matter what the market's doing, because you got a fixed rate loan. The only day it matters is the day you bought it and the day you sell it. Anything that happens in between, you're not worried about. So anyway, I thought this would be helpful. And like I said, I'll give you 30 minutes worth of information as condensed as I possibly can. And so if you have questions, feel free to add a comment down below, or feel free to call us. I mean, I'm happy to help. Even if you're not in our community, I'm happy to help. If you're looking for a pre-screened real estate agent in another part of the country, I've got relationships with realtors through different real estate conferences and events that I attend each year. I've got agents that I would feel comfortable referring my family members to, that I'd be happy to connect you with. So if you thought this was interesting, hit the subscribe button, and you'll be able to see more videos just like this. I'm Sam Miller of RE/MAX Stars Realty. Thanks for watching. Have a good one, and I'll see you on the next video.